the most important thing about conflicts of interest is that it doesn't perceived conflicts of interest and actual conflicts of interest are the same thing. It doesn't matter. If I think you're conflicted, you can't change my mind, whether or not you accepted the bribe or whatever you want to call it.
Hey everyone, this episode is brought to you by Namada, the shielded asset hub rewarding you to protect the multi-chain. So not only can you protect your own data across any asset and any chain, but you also get shielding rewards for strengthening data privacy protections for everyone. So you can check them out at namada.net and follow their mainnet launch. Stick around, you're going to be hearing all about them later in the program. Hey everyone, this episode is brought to you by Re.al, a new permissionless L2 built on the Arbitrum Orbit stack by DeFi natives for DeFi natives for tokenized real-world assets. It's a very cool chain. Highly recommend that you go check it out. And they just started their rewards program. So you can type in re.al/rewards. You can use the code in the show notes below. All right, thanks everyone. On with the show.
All right, everyone. Welcome back to another episode of Bell Curve. Before we jump in, quick disclaimer. The views expressed by my co-host today are their personal views and they do not represent the views of any organization with which the co-hosts are associated with. Nothing in the episode is construed or relied upon as financial, technical, tax, legal, or other advice. You know the deal. Now, let's jump into the episode.
Hey everyone, welcome back to another episode of Bell Curve. In today's episode, I've got Jim Parillo of Figment Cap, friend of the pod, subbing in for the Framework lads. This was a great episode. We spent a lot of time recapping SBC from Jim's perspective. We spent some time on the apps versus infra meta, and we talked a little bit about prediction markets and futarchy. So that was very interesting. And then we spent basically the entire last half of the podcast talking about the Eigenlayer airdrop saga, which CoinDesk reported on earlier this morning. And at the time of recording, all we had was the CoinDesk perspective to go off. And just for the sake of fairness and reporting the entire story, the Eigenlayer team launched a blog. So I wanted to I'll drop that in the show notes for people to get kind of the other side of the story. And I'll just summarize it for 30 seconds here, which is basically, from Eigenlayer's perspective, look, there were a bunch of AVSs and teams which wanted to reward a whole bunch of different people. Some of those happened to be Eigenlabs employees. They actually linked to a blog post where AltLayer specifically mentioned Eigenlabs, but they recognized back in May that this could potentially create a conflict of interest. So they rolled something out called the Eigenlayer Ecosystem Network back in June, which was inspired by the Protocol Guild, and they made it so that you could only airdrop to the foundation. And so, some of the discussion later in the podcast was a little bit critical. And so I just wanted to make sure that we're accurately displaying both sides of the story here. I also want to say all of this news just broke today. I'm sure there's going to be a lot more information, that comes to light here. So just take all that with a grain of salt and wanted to make sure we're representing both sides of this issue fairly. All right, guys, hope you enjoy the program. All right, everyone, welcome back to another Roundup edition of Bell Curve. Today, I'm joined by Jim Parillo of Figment Capital. Has been on the show before. Jim, welcome, buddy.
GM, sir. Not the topic I thought I would be asked to come and talk about, but like the next visit to the Bell Curve. But like great to see you, sir. How was SBC?
You as well. I actually missed SBC because I had my parents have this cabin in Canada. I grew up going there during the summers, and this has been on the calendar for like a year. My mom was like, hey, they moved out to Montana a couple of years ago, and they're like, this doesn't make sense anymore. We're going to sell this place. So my parents have been up there for a couple months. And then when I went up to visit, they were like, my mom was like, yeah, we really love this place and we're probably not going to sell it. So she's reneging on her, what she said, but it was really nice to be up there, but I missed SBC. Were you able to go?
Yeah, we were there. Dougie and I were there the whole time. It was good. It was got to catch up with a lot of the teams that we've like invested in, which is usually the most valuable part of these things. I was there like searching for applications, and I saw mostly infra. So good and bad. And I've got a lot of thoughts on like that part of things these days. Like I've been writing a little bit about it, and I need to like post it somewhere. But so it was good overall. Got to catch up with the reETH team a lot, who they like hosted like there's like an internet cafe across the street, and so I kind of just hung out there for a couple of days and jammed with the team. But it was good, yeah. No, and I've never been to Montana. It's on the list. Like I've heard amazing things.
Dude, it's awesome. Yeah, we got to get you out there at some point. All right. So before we get into the topic of the day, and the reason we brought you on outside of your deep knowledge and penchant for SaaS is what I'll say. I'm curious to get your and you did a great presentation actually at ECC about conflict of interest 101, which is what we're going to be talking about today. But before we get into that, actually, I do want to get your take on the apps versus infra meta and sort of vibe shift that we've seen, because I listened to the chopping block episode, and they were talking about, look, and this was my feeling as well at ECC, and a lot of people, having gone to ECC this year, is like, look, my sort of high level take around this is that a lot of the talks at ECC this year are similar to the ones that I heard at ECC last year, except there's been some progress in the roadmap, but we haven't seen the requisite users. And if anything, it almost feels like there are more problems than there used to be. And we're kind of, resorting to these, I don't want to say crutch, because that sounds a little pejorative, but, we're sort of aligning on these solutions that it's like, hey, we could have just figured this out. We knew this existed from day one. And it just feels like this kind of stagnation. And, I'm not here for the nth MEV TEE talk. And I think everyone kind of wants to see applications. Do you feel that way as well, or where are you on that?
Yeah, I think so. I mean, so the one thing you did miss was like Max Resnick's New York City tour about MCP. That was like on full display. Like, yeah, I think I heard him talk like 3 different times about it. Some really interesting conversations. Like it's interesting where and how that would, like how long it would take for that to actually ship on Ethereum is like, if ever, would be an interesting conversation to have. 5 years, maybe 10 years. Like I would love to know more about that, but like, it's interesting. I think like, yeah, the application I think is like where people are kind of starting to hope for a little bit and seem to be hungry for. I think like, so I work at Figment Capital. It's a venture fund, right? We call ourselves like an infrastructure fund, and even we're looking for like applications now for a lot of the teams that we've invested in. And some of them are doing a better job at like finding founders and teams that want to build applications. I think like, here's like the hot take, which would be like, I think it has to do something with like tokenomics. And like, I think VCs are kind of like in a weird, don't feel sorry for us, number one. But like, number two is like, I think we're in a kind of like this weird spot where like the low float, high FDV thing is like, I think caught everybody a little bit off guard. And at the same time, okay, so I don't know what's better. So what's the alternative? Is the alternative like low float, low FDV? Is the alternative high float, high FDV? Because like, look, everybody wants high float at high FDV. Like that means everyone made it. And so I don't know how we make that a reality, like from day one. I don't think it makes probably a lot of sense. And I think with like so you start to talk about like these like lockup periods that exist. And if you tell me like there's an L1 and the lockup is like a year and the vesting is 3 years, I understand that it's going to take a long time for like an ecosystem to develop. And ultimately, like if it's a proof of stake network, I can maybe stake the tokens and I'm like earning additional tokens. Like the blockchain won't shut down in a year. It won't shut down in 2 years. It will continue to produce tokens. Like there will be some value that like sort of accrues to like the L1, even if it's like just more tokens and no transactions. And a lot of these exchanges like are essentially requesting like longer lockups, right? They want the 1 year lockup. They want the 3 year, like they want the 1 year lockup for sure. And what we see is like kind of like a lack of like innovation, I think even on tokenomics generally. So what do applications do? A lot of them have like the same lockup periods, right? They have like a 1 year lockup. They have like a 3 year vest. And other than like the very like kind of like foundational applications that exist on Ethereum, Aave, Maker, Uniswap, like name an application that existed from like a Solana application that like still is like the leader today that was the leader in the last cycle. And yeah. I don't think you can name one. And so the reason why is because like as soon as pumped out fund becomes like, one of the reasons I think why is because like as soon as pumped out fund comes out, there's like, and it has success and it has some sort of product market fit, like all of a sudden there's like 20 pumped out funds that launch next. And it's like just this like swishing and swashing of like the same capital trying to like airdrop farm. Now Pump.Fund's been able to keep its lead, which is awesome, and I love to see it. It's like it's been great. Like the revenues numbers look fantastic, but like maybe there's like maybe there's not like a one size fits all for like these tokenomic models. Like I'm not suggesting like full unlock like on day one, but like if the idea is to like iterate on the application layer, but the lockups are like 4 years long for like these applications, like we either need more innovation on the application layer, which I do think we need, and newer applications to come out, which necessitates potentially newer and better and more innovative infrastructure down the road. But at the same time, like I think it's a one size fits all, like kind of 1 year lockup. Like it makes it scary for like I think some investors to like think, okay, I'm investing in like this application that like could maybe lose all of its users in like 7 months or 8 months, like and be in it for like 4 years. Like I think it's like the cost benefit maybe isn't there, and there probably needs to be some like thought around it, a little bit more like nuance. I think kind of like in how we think about it.
Okay, so I have a lot of thoughts on this. Here is the way that I've been thinking about it. When we were just getting into crypto blockworks, when we started it in 2018, 2019, there's sort of something similar that was taking place, which is all the companies that were getting funded were essentially infrastructure, but they were CeFi infrastructure. So this was the era of prime brokerage and custodians and things like that. And that was the hot thing to fund. And all of this VC money got poured into that particular category. And then what ended up happening over time was just this sort of natural market correction, because the number of customers to support those infrastructure companies simply wasn't there. So there was a massive wave of consolidation. And frankly, that part of the market is still hurting pretty badly. Yeah. I think we are a decent way through that chunk or that same cycle for on-chain infrastructure. And eventually what needs to materialize here, because, to just say something pretty obvious, none of these infrastructure companies are worth anything if they don't have any customers, and the customers are the applications, right? So I haven't really bought this idea that, you're essentially taking the same bet, which is that customers are going to come into this space and actually use the on-chain infrastructure. That said, I do think an enormous part of this has actually been really unfairly focused on VCs. And I think that putting VCs in the crosshair here and moralizing to them about what types of investments they should make is pretty ridiculous. I feel the same way, from a media seat of people saying, hey, the media should report on this. Medias are businesses, our job is to try to get a sense of what people want to see and to give it to them. And at the end of the day, I really, people complain about media all the time. I don't think it's actually a fixable problem. Most people just aren't honest with their actual content consumption preferences. Like, you are being served what you actually want to see. But I sort of feel like VCs are unfairly in the crosshairs here. I'm not actually sure. I'd push back with you a little bit on the unlock thing. I actually do respect Chris Goes at Anoma. Yeah, tried just an unlock from day one. It's a bold experiment, and I actually think it might work out. And I just respect anyone trying anything new. So huge shout out to the team at Anoma for taking a shot on that. And it seems like he's got a lot of pushback, which I just don't think is deserved. But I'm of the mind that the 4-year unlock here isn't what's broken. I actually think that works pretty well. That's how I feel about most corporate governance stuff. Like, the modern corporation is actually an extremely effective way of organizing people. And we've figured out this stuff about unlocks and how long these periods should be. I don't think we really need to innovate on that much. The issue, as I see it, is one, there's an oversupply of capital for one part of the market. And then two, the initial price discovery is not correct here. And I actually don't think that's VCs. Everyone's like, the VCs are dumping. The VCs have lockups. I do think there are two actors here which don't catch nearly enough flack, which is the market makers and the exchanges. And there is a lot of black magic that happens in between market makers and exchanges. And anyone that has listed a token, maybe on some large overseas exchanges, knows what I'm talking about, because these guys actually have someone, should look into what's good.
And like, it's not clear that those tokens are locked up that like these exchanges are receiving, which like I've heard that they aren't sometimes for the bigger ones. And so like, I agree 100%. And like, maybe the lockup actually isn't the problem. Maybe the airdrop farmers are the problem. Maybe like, VCs are not dumping like the first year. VCs don't have the tokens to dump. And so I actually like, I respect the rebuttal, and also huge shout out to Anoma. We're investors in Anoma. I think there's some challenges around specifically the Anoma like full unlock that maybe is better for a different like podcast or something. But like, I think there are some challenges there that I see. But like, I think generally, like any sort of like, look, like you say, low flow FTV doesn't work, right? So okay, cool, we're just gonna keep it unlocked. Like everybody can do whatever they want. I think it's like, and now they're getting flack for that. And so it's like, okay, well then what's your solution? Like, why don't you give me a solution that like actually works? Here's the barbell, here's the spectrum. Like we've got both ways. And let's see what happens in this example. So I agree. I think I'm doing a lot of research right now on like two areas that like I've kind of not paid as much attention to, just to understand how it works and trying to understand how this market actually works. The first is like, I'm talking to a lot of like OTC desks, because I don't understand how that process works. And like, I think these people who are in the intermediaries have huge insights into like how the private markets work. Like we generally just like buy and hold. And the second thing is like market makers. Interestingly enough, and I have like a whole DDQ and I ask them a bunch of questions and like, Jesus Christ, you're asking so many goddamn questions. Like you could probably start your own. A, I'm not starting my own. I don't know how to do those things. I don't want to do those things. But B, like what I've found is like market makers are a lot less open about what they do and how they make money and like how they operate within this space. And I understand why. But like it's fascinating to learn. And so like what I wind up having to do is talk to like people who used to work at market makers because they're a little bit more willing to discuss.
I've gone down this road before too, and it's not just crypto actually. Of all of the disciplines that I, tried to teach myself when I first got into this space, the market making corner of TradFi is the most opaque by a landslide. People will often come to crypto and say, "Oh, it's very complicated." It is much easier to learn what's going on here in this industry than it is in market making in traditional finance. And yeah, I mean, the reason why is they make a ton of money and they have no incentive to make that transparent and available for everyone. That's their edge. But yeah, I think that I do think the point is, I do think that VCs are really unfairly in the crosshairs here. And if anyone listening to this podcast, we could just reorient a little bit of the, the pressure around, kind of exchanges and market makers. I think that's probably who deserves this little bit. And US regulators who have basically made it so that the early returns are just accruing to VCs instead of retail. And I probably flipped a little bit, and I'm more on the train of ICOs were just a better format. But last thing about just applications versus infra in general, I have a theory I want to run by you. So if you look at all of the major applications that are working today, they have to do with there's kind of this even in traditional commerce as well, there's this relationship in between sort of money and commerce. And what I mean by that is like originally like our modern form of banking was trade finance, right? Where you had a bunch of people who were like millers and stuff like that. And they're like, hey, I've actually got these order receipts, but I need some liquidity in the meantime. And banks issued, very safe deposit receipts. And so there's this sort of evolution of money and commerce going hand to hand. And if you look at crypto, I think basically every application that's taken off, there's a connection there in between the growth of these like commodity things like Ether or Bitcoin as money and applications that support it. So the examples that I'll give you is, what are the biggest applications in Ethereum today? Uniswap, MakerDAO, Aave, right? And what are the use cases around that? Well, for Maker, it's people that want to get leverage on their ETH for the most part. It's basically the same thing for Aave. And then Uniswap exists because there's this MEV, right, sort of arbitrage thing around the price of Ethereum on-chain versus off-chain. And so these things are related. And I do think that the larger these sort of token ecosystems grow and the more complicated the underlying machinery becomes, that is where you're going to see apps. And so, everyone sort of calls apps these consumer type applications. I'm sure that those are coming, like Blackbird. There are some examples, right? Like Blackbird or even Polymarket. But my guess is that we see more, Uniswap or Aave type applications in the future than not. And those are also interrelated with all of the infrastructure conversations as well. So I don't know. That's just my theory about what drives applications in crypto for the most part. But
yeah, agreed. I think like, the one kind of innovative thing that's finally kind of making some mark on the space that's like some combination of all of those is like perps dexes, and like the second thing is like prediction markets. And I think we might be seeing like I hope that this is something I'm saying and that I can look back on this and say this correctly, but like I actually think that like prediction markets might be one of the most interesting things like that's coming out of crypto, particularly because it could like kind of just reinvent like what a market is. And like, I think Frankie had like a really interesting tweet about like, it's about what you do with the information once you have it. Like that's, and how are these applications going to like consume, digest, and like, organize that information in like into valuable insights, investment or otherwise. But we could actually be seeing like a pretty interesting transition of like how markets operate, like fundamentally how they operate if we have like kind of group think on some of these like esoteric things, and then kind of are able to apply what that means to maybe financial markets as well. So I don't know. Yeah, like I think like I agree. So like I think the infrastructure stuff is obviously really interesting. That's why we invest in a lot of it. And then like I think other things that kind of are tied to the financial kind of flywheel that you mentioned, and how it contributes to that is going to be probably the next set of innovations before we get these like consumer applications and stuff, because like it's all information. So how do you gather this information? And another interesting thing, so this is all stuff I wrote about, holy shit, like yesterday, was like how do we like change human behavior? Actually, interestingly enough, like I think prediction markets can change human behavior in very interesting ways. Like I think a lot of this stuff has been around, like a lot of the bets on Polymarket have been around like the election. And we were talking with a friend of the fund, like Nathan Worsley, about like information markets. And what he had mentioned was like, like, hey, there's statistical arbitrage here as well, right? Like, so Kamala Harris was like at like 20%, and like pretty good bet that like it's probably going to be closer to 50 by the election time. And so like you could make a bet that just like whether you care or not about the US politics, like you could just make that bet because you think it's interesting and you think it's like statistical arbitrage. But at the end of the day, like what winds up happening to you as a result, like you start to consume more political news. You start to pay attention and like pay attention to like maybe you're looking for maybe you clearly have biases financially on the outcome, but like you're kind of looking for bad news about Trump, you're looking for good news about Harris, or vice versa, right? But meanwhile, you're actually educating yourself in some way, right? You're paying attention to a new thing. If you're investing in Tesla, maybe you think because like Elon Musk is a genius or something, and then all of a sudden you start paying attention to like green energy maybe, or the stock market, or and like you wind up like growing as a result of like as a person, or like maybe even intellectually based on like, and your interests grow as a result of this. And so modifying human behavior through incentives is something that's like really interesting. It can be used for good, certainly be used for bad as well. And like one of these like interesting projects that we're not investors in, but I thought was really interesting is like this like vape to earn like project, because like what you hear when you hear vape to earn is like, cool, you're like you're incentivizing people to smoke more, but actually like the way that the model works that like the less the nicotine is in like the pods, the more you earn. And so with that information, like if you can gather that information, right, like there's like a ton of health information there that's never been available to people before, like how often do they smoke, like how strong do they smoke, and you could potentially incentivize people to kind of like quit addictive substances through incentives. So like I think there's like some cool things that like are kind of on the cusp here of how do we modify human behavior for like their own benefits, like their own health benefits or otherwise. STEPN might even be a good example of this, right? An early example of this.
Yeah, there's a lot. Okay, there's a lot there. So I actually heard she's one of the founders at reETH. Her handle is Brother Bing. I think it's Shu Yao. But she was actually saying that one of the things that they're looking at is some of these old failed ICO era type ideas, and maybe they were just early but not wrong necessarily. And I actually heard someone talk about this I think this was a Fred Wilson blog actually from 2018 or 2019, something like that. So I might be misattributing here, but he referred to this. There was a game back in the day called Dot Bomb, and it was every dumb idea that got tried in the early 2000s that ended up being massively successful later on. So it was like Webvan to Uber, or Pets.com to Chewy, or whatever it was. And I do think that some of those old ideas that you heard about, coordinating people around these incentives is super interesting. Prediction markets does feel like something that's very new and I'll say it's not new. Actually, there are lots of other countries, like you can bet in the UK today on prime minister elections and stuff like that. And it used to be legal in the US.
Credit default swaps and options are arguably
CDSs.
prediction markets. Yeah.
Yeah, and arguably, actually, crypto is trading like a big prediction market based on this election at the moment. Basically, Bitcoin is a Trump win coin at the moment. But okay, so there are two. It's pretty interesting because I'm going to pull up this tweet from Hasu, and he's a pretty I generally enjoy his takes, and he's got obviously he's a very smart dude with a good head on his shoulders. But he actually tweeted the other day that he thinks that prediction markets are a threat to democracy and an acceleration towards plutarchy. And I think that in a sense, it's almost like maybe the difference between proof of work and proof of stake. You could, right? This is the big criticism around politics and money, that it's too easy to influence outcomes. And people have made this analogy between proof of work and proof of stake, that proof of stake is proof of work, but without the extra steps. And it's like, well, the extra steps are actually important because you actually have to do real stuff, right? And there's an additional stakeholder, and it actually is a pretty different system. And you could argue that politics today already works like prediction markets, and there's already a ton of money. But when you make that relationship more direct, you can just bet on these outcomes, and it actually makes it more likely to happen. There are definite negatives there. And where this is being one of the interesting concepts, we had a long debate on this actually on the Blockworks Slack last night about futarchy. So futarchy and this is, I believe, being tried out mostly in Solana today, but futarchy is a form of government, MetaDAO, proposed by an economist, Robin Hanson, in which elected officials define measures of national well-being, and prediction markets are used to determine which policies will have the most positive effect. And so here, I'm going to keep drawing this analogy of proof of work versus proof of stake, which is, in today's, the way that it works today is you have to elect all these people, and then they actually have to go out and prove to you that, like, hey, I'm this, credible, very qualified person that should be doing this, and then they actually have to get laws passed. And now, once you define the parameters, it just becomes a game of money, and it's just much more easier to directly, you could make this. The bull case for this would be, hey, you're going to have a bunch of people. Everyone's going to be influencing these policies based on actually having skin in the game. And, you eliminate these sort of personal relationships. Like if you could imagine something like the relationship, Dan Smith gave this good analogy in our chat, between a board and a CEO, right? Okay, the board elect the CEO and maybe we're friends and we're not going to do that. But if this was like a futarchy type situation where everyone could just vote on it, maybe you'd eliminate some of that bias. But on the other hand, if you are a negative actor in this situation, it's really easy. It's much easier to influence outcomes if you have a lot of money. And so I get Hasu's point about everything converging on plutarchy at the same time. And so it's just interesting.
We're already there, right? So, I mean, I guess like there's always going to be gameable ways to do this, right? Like you could argue that like, you could look at like the amount of money that's being spent. You could also look at the number of like wallets that are actually voting in both ways. I don't think we see that like type of data, but you can always game that as well. Maybe there's proof of personhood in some manner where like you can't have the same person, and now you have like a bunch of people in some other country that are like being paid to just like put $10 on something. So it is proof. They are a person, but maybe they're not even like US citizens. Right. And so I imagine there's like ways around this. I don't know if ZK Tech or something like that solves this. I'm sure they'll find a way to fit that in, but like, I'm, or TEs, who knows, but like, that's just me being ridiculous, but like, I don't know. I think like we should test it out in certain ways and see what the outcomes look like. And yeah, I think on politics stuff, it gets dicey, but like PACs exist in the United States. Like nobody knows who's contributing to what nearly as much. And like money does rule the world already, like in politics as well as in like policy. There's a lot of lobbying going on. This feels like another form of lobbying in some ways, but for public opinion. And like, you never know what happens when like when you see something you don't like happening and you see the prediction, like it may not make me go on to Polymarket and change and like put $100 down on like candidate B, but it might get me out to vote because candidate B seems like they're losing, or maybe it makes me apathetic because I think it's a foregone conclusion. So like you can have it both ways. And I think that's more of like a personality thing than it is like a, get out and vote. Like if you look like you're losing by a ton, like I imagine, you have a lot of money in your like treasury, and you probably start spending it to try to like, ideally not to make people bet on like who's going to win, but like to make sure that the voters actually do come out. And you can use it as like an underdog scenario as well. Like we're underdogs here. Look at this. Like we need your vote. Like there's worlds where this like can be a motivating factor for people.
I do want to actually just call out this one strain of argument that I've seen around specifically the election odds and poly market. And, not to get political here, I've been talking a lot about politics on this show lately, but, when the Trump election odds were way on top, poly market was the future of media. And look at how bad the mainstream media is. And poly market got it right. And now that the odds are reversed, it's like anything that can be manipulated will be manipulated. And the Democrats are pouring money in to influence the odds of the election. Come on, guys. You can't have it both ways. You either got to say that the system works or it doesn't work, but you can't.
It doesn't. Yeah, that's crazy.
A little bit of intellectual honesty here.
We could all use a little bit more intellectual honesty in in our everyday lives.
Hey everyone, this episode is brought to you by Namada, the shielded asset hub protecting the future of the multi-chain. Namada is a chain that's near and dear to my heart because in previous seasons of Bell Curve, we've talked about how the cardinal original sin of most blockchains is not thinking about privacy from the beginning, but also because if we want to onboard a whole bunch of applications, it doesn't work in a default transparency setting. So Namada not only brings about Hey everyone, this episode is brought to you by Re.al, Re.al. They're a new permissionless L2 built on Arbitrum Orbit for tokenized RWAs. So basically they've got this portfolio of real world assets that actually exist out there that generate yields. They import them on chain and find ways to reward their users very creatively. So one of the cool things about Re.al is that it's the first L2 where 100% of profits from transaction fees and fees from protocols deployed onto the chain accrue back to the L2 governance token. And currently, I mentioned this at the top of the episode, but they have a reward program going on for early users of the chain where 10% of the RWA tokens are being distributed, which is very cool. So you as a user can go over there and provide concentrated liquidity, trade, borrow, and leverage tokenized RWAs, including T-bills, real estate, and tokenized basis trades. So again, head over to re.al/rewards, and you can use the code found in the show notes here. Tell them that I sent you. Thanks, Re.al, for making this possible. That, Jim, I think is a good transition to the the main course of this episode, which is conflicts of interest 101. So this is actually something that you and I have been chatting about for a little bit. You gave a great presentation that unfortunately I missed live. One of these days, I'm going to catch your presentations live because you do a very good job with them. But you talked about conflict of interest 101 at ECC this year. And maybe just to tee this up, there was a sort of a bombshell report that CoinDesk put together. So shout out to Danny Nelson and Sam Kessler from CoinDesk for compiling this. But, let me actually just grab the title of this. I'm having trouble opening it on my computer right now for loading reasons. But, the title of the report is Top Crypto Startup Drove Other Projects Airdrops to Its Employees. And so it looks like we don't have a ton of details around this yet, but there were LRTs, a couple that were named were Renzo, Altlayer, that actually gave pretty significant airdrops. So about 5 million at peak prices, 1 million today.
Also,
EtherFi also gave airdrops to specific employees at, I believe, the Eigenlayer Foundation. They might have been at Labs and they moved over to the foundation. And so, this just raises conflict of interest concerns because Eigenlayer is going to have an enormous effect as the marketplace here in terms of who is successful for LRTs. And so even if it's just optically, tipping the scales towards one versus the other, it's not great from a credible neutrality standpoint. And I think this sort of builds towards this conversation of, how should we think about conflict of interest within crypto in general? Because recently there have been a couple of, I don't want to say scandals, but actually another sort of Eigenlayer Ethereum Foundation, where Donkrad and Justin Drake, were revealed to have a pretty large, advisor shares in Eigenlayer. They've since said that they're going to donate these to other projects. And then also something happened around this as well with Polychain, one of the Polychain investors, Niraj, taking personal shares for sourcing the Eclipse investment. And, the old founder, Neil, it was very close to Niraj and slept on Niraj's couch for a number of months when he was coming up with Eclipse. And so, and it's a little bit weird because Polychain actually backed Niraj's new company, Ritual. And so all of these things just, everyone in the industry kind of looks at them. It doesn't make you feel great, but Jim, you're a conflict of interest expert here. So walk us through what inspired you to create that in the first place, and how do you read this most recent news with Eigenlayer?
Yeah, so I'll start by disclosing some conflicts of interest. And I'm going to try to be as unbiased as possible here, or as neutral as possible here, but I'm only human, so don't crucify me on Twitter or whatever. And so we're investors in Renzo, which is an LRT that was named in the article. We're investors in Eigenlayer, which was also named in the article. And when you look at the airdrops, it looked like in order of magnitude, right? Renzo, AltLayer, and EtherFi. Renzo, I think, airdropped somewhere around, at the time of airdrop, $16.666 $1,000 to each employee, the employees on this list. AltLayer, I think, was around $33,000, and EtherFi was around $80,000 per person recipient. So that's a lot of money in total, right? That's over $120,000 to each one of these employees. It was noted that Sriram did not receive that, so he was not on that list, which I think is a valuable thing. And I think this is probably something that is pervasive. And this is obviously Eigenlayer has a bit of a target on its back because it's the biggest project that's launched in a really long time with a lot of hype. So it's important that light is shined on the biggest, most promising projects in the space. What's not clear is there's a lot of weird things that happen in the airdrop space that we just don't know about. We don't even know how we could know about it. It's probably pretty easy for an employee to unless there's levels of review here, it's probably pretty easy for an employee of that's going to get an air that their company or their team is about to launch an airdrop to just add their own new wallet address at the bottom or in the middle and give themselves $150,000 or $1 million or $2 million of unlocked tokens. So they're getting vesting. They're incentivized to work really hard and to make this network as successful as possible. And there's these there's a pull to for self-interest or over team, over protocol, over the network, the place where you work. That always exists, right? There's two wolves. And I think we don't know how pervasive this is. And presumably it's pretty bad is what I would imagine. I think generally speaking, this is probably a learned, a learned action from people. This is a learned thing that people do. And I don't think Eigenlayer was the first one to do it, or the employee or employees there. I think this is probably pretty pervasive with every large and maybe even small project that launches a token. And so maybe it's better to just kind of take back. So I've done this talk. I did it at ECC at a project at an event called Unaligned Layer, where we did our most unaligned takes that we could think of. We did something similar in New York called Heretics, which I did maximum viable issuance, explaining that minimum viable issuance has no viable reason to exist, and that we should actually think about why we should maybe increase the issuance rate versus reduce it right now for Ethereum. But conflicts of interest in general, right? For those of you who are not familiar with it, or anyone working at a protocol right now, listen up. A conflict of interest is a set of circumstances that creates a risk that professional judgment or actions regarding a primary interest will be unduly influenced by a secondary interest. And conflicts of interests are a clash that most often occurs between personal responsibility for the where you work and your own self-interests. That is what a conflict of interest is. And so it usually exists when there's unequal access to information, impaired objectivity, or there's some form of like biased decision making that could occur. And the most important thing about conflicts of interest is that they can, it doesn't, perceived conflicts of interest and actual conflicts of interest are the same thing. It doesn't matter. If I think you're conflicted, you can't change my mind, whether or not you accepted the bribe or whatever you want to call it. And so it's important in the eye of public opinion that like you appear neutral, that you appear not conflicted, and that you essentially do things that don't raise like concern about the fact that like you maybe are acting in self-interest over the interests of the betterment of like the network or the protocol. So that's sort of like kind of like a good maybe base of like why conflict of interests are important. And you can be influenced like to make a decision because of like potential gain of power, of prestige, of wealth. And they can occur when an individual makes or influences a decision and does so for some personal gain. That may be unfair, it may be unethical, and it might be, or it might be illegal. And there's like ways to manage conflicts of interest. It's actually pretty simple. Like, so I come from, before I worked at Figment Capital, I worked at a company called KPMG. It's a public accounting firm. They audit a lot of the publicly traded companies like in the world, like all over the world. And I started as like a lowly associate, and then I worked my way up to senior, and then I worked my way up to manager, and then I worked my way up to manager 2, and then I worked my way up to senior manager, and then I worked my way up to managing director, and I was up for partner, and then I left to do this, which like shoot me. Sometimes I think about.
No, you
but
made the right decision.
I think I made the right decision. I'm much more passionate about this than I am about other ledgers, accounting ledgers. I love distributed ledgers more so. And what I realized like during that period of time is like it's not linear, but there's like a scale, right? That exists. Like the more responsibility you have, like in fact, like comes with like the more seniority in the position you have. And so like they're not created equal. When I was an associate, I was like able to like hold stock in companies that like I didn't work on, or that like our office didn't like work on. And then like as I moved up the ranks, like all of a sudden I like, wasn't able to like hold any stock. I had to hold like ETFs, and they had to be like in a like partners need to like hold ETFs like in a trust that they don't control and they don't have visibility into. They don't even know what they're holding. And so I think like, and why do these exist? And like, how did I even know that these are like things that like are problematic or that, because there's something called conflicts of interest policy. And it's a incredibly important thing. It's like there's a code of ethics and there's a conflicts of interest policy. And essentially what that does is, it like essentially requires me to like disclose what my conflicts of interest are, for someone to review what those conflicts of interest are above me, and then to tell me whether there's a problem here that I need to like think about, and maybe even remove myself either from the engagement, or I need to like sell maybe the stock, because I feel like remove even the perception that owning this thing could potentially lead to me making poor decisions that would impact the firm. It's at the interest of my own, like at the cost of my own self-interest. So that's sort of like, I think, what I talked about for the beginning of the talk, and then I kind of went into like crypto stuff a little bit.
And so one other thing as well, from an organizational standpoint, I really like this point about, the larger it's like, the bigger you get, the more responsibility that you should have. From a media company, in the beginning, right, you're really small, and it doesn't really make sense to draw these like strict walls. But as you get bigger and bigger, and as like Blockworks reporting has become more influential, there are very strict firewalls that exist now inside of our business. And so it actually is kind of the bane of my existence. A lot of people are like, hey, man, we're got this thing I want to report. And it's like, I've actually got no influence over that. And I'm going to direct you to one of our reporters, and it's not my say. And so these things exist for a reason. And so I think that one of the challenges actually, and like, look, every industry goes through this, right? Like all of these all of this regulation that exists in finance now happened because there wasn't strict regulation in place and people broke the rules. There are now divisions in between different branches of investment banks that didn't used to exist, right? In between the S&T, the sales and trading arm and the research division. And yeah, there's a really good reason why those things should be super separate. Now, are they really that separate? I don't know. But but at least they're more separate than they used to be. And so, and the other point that you made that I really like is that sometimes it's just about the optics, right? It doesn't even really matter if you as a person are actually compromised. Just the optics that you could be are really important here as well. And so, I think that there does need to be a little bit of a look in the mirror and a change, both at companies that are operating within the crypto space, but even for frankly, a lot of the governance processes of these big L1s is really opaque. And everyone says we don't want to replicate what the Federal Reserve does and different central banks do. Well, look, maybe this is a heretical take, but those central banks are actually pretty transparent. You can put your tinfoil hat on and you can say that they're owned by Treasury, whatever. I don't think that they are, and at least they have minutes, right? They actually record what is said in meetings, and Jerome Powell gets up and takes questions about, sometimes very adversarial questions from reporters about why he made the decisions that he made and why everyone is voting the way that they are. And the world has a really good understanding of why the Fed is operating the way that they are. You just don't really get that transparency in this space. And again, I know that's going to sound heretical and people are going to say, check the chain. Look, everything on chain being on chain is a massive, massive improvement from a tech standpoint, but it has to accompany real world human processes that everyone agrees to follow. I've seen
Yes.
some of the Steakhouse guys tweeting about this. Adrian is on a crusade to figure out how much stake Coinbase has, and she's like, "Look, guys, you got to do more than just checking the chain here. If they don't flag it, there's no sleuthing that's possible to figure this out." And so, I do think that the actual technical improvement of things existing on chain has given everyone a little bit of cloud cover to say this industry is really transparent. When in reality, we just need much more. We need, as we have ascended to the world stage and as we've become an issue in the U.S. presidential election, the stakes are higher. And this type of stuff that maybe flew a couple of years ago, it can't fly anymore. It just can't.
I agree. I mean, and so the solution to conflicts of interest, by the way, is disclosure.
Right.
That's it, right? Just disclose that you have it, and and disclose it in a manner, in a venue that is knowable, right? I think one of the things that got a lot of flack for Justin Drake was he is yeah, I disclosed it, and it was on some obscure website called orb.land, where it was a response to a question about what do you think about Eigenlayer, and he's like, hey, I just want to let you know, I'm an advisor now. And I was like, what do you are this? It'd be hey, yeah, I disclosed it, guys. I disclosed it on this in Reddit somewhere. Oh, cool. You're fun guy 42069. I didn't know that was you. It requires a little bit of common sense, and ultimately, I think where I really went into town on this is look, yes, Eigenlayer is in the news today, right? And what I've noticed is that they announced something yesterday about hey, we have this repository where people can put their addresses, and these are the addresses and the identities of the people that are working within the Eigenlayer ecosystem. If you want to airdrop to them, you should airdrop to them. If you don't, you don't have to. That seems like a good response to this, and it's completely up to them what to do. I think there's some challenges to that, particularly around the personal side of things, and the people talk, and there's ways to do that. But at least people can check the chain, right? Now they can check the chain. If there's an airdrop to those wallet addresses and it's $80,000 or 16 or 33, you can pour over it. You can scrutinize it.
And CoinDesk reporters did. Reporters did. They actually checked
to their credit.
To their credit, yeah. CoinDesk, shout out to Danny Nelson and Sam Kessler. This was really excellent reporting. Actually,
it was great reporting. Bravo, right? That's the type of reporting that we need, and we need more of it. And I think it helps. Self-policing. We have to self-police it. If we're going to be the future of France, right? We have to be at least as good, if not better, than like traditional finance. And if they have these rules in place, like we should be holding ourselves to those standards, especially when we're becoming like when we're raising at like $100 million, especially if we're raising at $500 million or $1 billion. Like you have to operate and act like a $100 million, $500 million, $1 billion company. Like that's just sorry. Like some of the fun is over essentially. And I think like what you do is like you have to disclose, but the question then is where do you disclose it? And like there's probably two places, and it depends on like what type of company you are. If you're a for-profit company, right? Like you don't disclose that I don't like if I'm a for-profit company, I have to disclose like publicly like all of my holdings. I do need to disclose that with my boss though, and the company I work at. Like there has to be somebody who has like some record of like what I'm holding and what advisory I have. Like, are you an advisor? Like, are you an angel investor? Like, where are you on this thing? Like, how did you get what you got? Like, did you actually invest? Did you just get free money? And we can talk a little bit about advisory because I have like a whole rant on that. And like the most shocking thing that came out of like the last 8 months or 6 months of this is that like, you look, EigenLayer's been around for a year and a half, right? Like, and they've been big for like a year. The Ethereum Foundation has been around for 9 years. They're about to celebrate their 9-year anniversary. Like that tweet or article that came out that was like the Ethereum Foundation is like due to public judgment, personal judgment of some of its like employees or researchers or whatever we call contractors. Like we don't have a conflict of interest policy. Like we're looking at it and we're thinking about building one, and it's been like months. They still don't have one. Like, hey, go on my Twitter account. I just pinned it. I posted the slide deck so you can look at it. And hey, EF, like all the way at the bottom, the last page is a link to the Carnegie Mellon conflict of interest policy. It's for researchers. It's for like academics. Use that as a rough draft and like do what you will with it. But like it's been 9 years and you guys are like the second largest cryptocurrency like network. You have leaders in your foundation, like vocal leaders that are flown all over the world that speak at all these events, and they're advising on a bunch of projects, and they're receiving arguably free money, and there's conflicts of interest here, and you don't even know what they are. And like this is a wake up call to the EF more than anyone. I think about like getting their house in order, because like this is unacceptable in my opinion, quite frankly. And like that's like step one on this process. Like get your house in order, get a conflict of interest policy, post it publicly. And then what happens there is like people have to go to you and like get approval or resign. And like from their position, because it's too valuable.
It also protects them. It protects them, right? I mean, that's from an organizational standpoint. You want to have this type of thing in place so that you can point to it and say, "Hey, my employees violated this, and we're gonna deal with them appropriately or whatever." But for EigenLayer,
or the flip side, which is like, I got approval for this, right? Like I raised this, and they said go ahead and do it, and I did it, and so like I'm okay.
I have a feeling that details are going to come out around this EigenLayer situation. Obviously, there's been an enormous amount of reporting done already. I just, based on the initial reporting, here are the questions, right? How big is this list? How many employees were involved in this type of thing? How much information filtered back up to the top of EigenLayer? And then ultimately, someone is going to have to be found responsible for this. I actually can't envision a situation where heads don't roll for this type of infraction. And look, I'm not throwing any stones, but it's only, we're recording this on Friday. I'm sure by the time this comes out, people will have remembered this. But there is a member of the team at EigenLayer who previously worked at a fund called Divergence, who's relatively senior and used insider information to farm, his own Portco's Ribbons airdrop. And so, there's going to be, I'm sure that there's more information that's going to come out around all of this stuff. Again, none of that, just because someone has a past of doing that doesn't mean that they're necessarily involved in it this time. But I would have to imagine that the board and EigenLayer just raised $100 million from A16Z is looking at the team with a microscope here. And there is going to be a big change of house within EigenLayer. How could there not be?
I think we've already sort of seen it a little bit, right? They just acquired the Rio team. I know a few of the folks on that team. I respect them highly. They come from like, I think a slightly different, like not from like the research arm as much as like from other areas of like the industry. I think like they've been putting, I know a few of them, I talked to them, and it sounds like since they've gotten there, they've like really kind of helped, I think, with a lot of like the operational side of things and like really try to button it up. And I think like generally what we're talking about is like buttoning things up here a little bit. Right. And like, just to your point, like we were talking about like market makers and exchanges, like this applies to you too. This conflicts of interest thing is exactly what it's all related. It's also conflicts of interest. Right. And I think like, so number one, there's that issue. Right. And I think like another thing since we're on this topic, right, I think another thing that I really want to talk about is like, like advisory. Because I think and also just so you know, like we're talking about projects, right? Like funds have conflicts of interest too, right? Like Michael, you mentioned like, you know, Blockworks has like, you know, like policy. Like funds have a policy, right? Like if I'm going to angel invest into something, like that comes like after the fact that the fund either gets its full allocation of like what it wants, or it passes on the investment, and then I have to get approval to like invest in that project. Like even if it's outside of our thesis, I have to get approval from that. And then we record that and we have like a log of like every investment I've made ever, like within the time I've worked here. So like, I'm not pointing the finger and saying like, you need to clean this up and this is your problem. Like this is a industry-wide problem, and it's things that like everyone has to deal with. The other thing that's important here is like, you have to think of like, so let's talk about like angel investing and advisory and like how the conflicts of interest, how I think those are both conflicts of interest. They can be perceived as, but they're slightly different. And I talked to like a bunch of people at ECC before I did the talk. And I asked about like, what is advisory, right? Like, what do you think about it? What do you think advisory is? And the general sense you get is that it's like free money. There might be a little bit of work you do. You might do a couple of intros. You might do some like once a month call or something like that. Maybe I'm on call whenever you need me, but like roughly it's free money. And the difference between angel investing and advisory in my mind, and I would love to be like educated here. So if someone disagrees, like my DMs are open, is that like when you angel invest in something, like I am putting my own capital on the line. I'm risking capital, right? That my money, and I have like upside on that. And the upside is that like the investment does well and I have appreciation on that. I made a good investment decision. Downside is I lose my money. The risk is that I lose money. When you get advisory, and so like when there's like those announcements of fundraising announcements, like what's on the page, it says like Jim Parillo, but under it might say Figment Capital. Nobody is thinking like, I don't think people look at that and go, Figment Capital is endorsing this project, right? They're saying Jim Parillo believed in the project, and Jim Parillo invested his own money in this project and wants to see it do well. That's one thing. Advisory is slightly different, right? What is like, the question is like, what is the benefit? The benefit is the upside, right? The appreciation of the asset, actually just receiving the asset is the benefit. And then the appreciation is like the cherry on top. What's at risk though? I didn't put any money in. And so what you have to think about is that what's at risk is like is your social, like you might think that like your social capital is so high that you personally like are a signal that you are supporting this project. I'm happy for you. I'm really happy for you that you have that such a high opinion of yourself. But presumably what they are doing is that they are actually like, but what they're more interested in that case isn't Jim Parillo. They're more interested in Figment Capital or Justin Drake. They're interested in Ethereum Foundation. And so what am I risking? I'm risking the reputation of the organization that I work at. That's the risk. That's the cost. The social capital, not that I've built, but that the organization that employs me or works with me has spent years building, and the neutrality or the credibility of that organization. And that's what I'm putting at risk, which is not actually something that I own. And so that's why advisory is such a weird one, because you're risking something that doesn't belong to you, and you get all the upside, i.e., conflict of interest.
The funny thing too about advisory is that this is also one of these concepts that's very prevalent, like having a board of advisors. So Blockworks, like for a long time, we were a bootstrapped company. We didn't have like a formal board because we never raised money. We never needed to. We have a board of advisors, and most of them aren't crypto people. Actually, they're people like Sean Griffey from Industry Dive, and it's just people like, hey, we would love to have regular meetings with people that have like built something that we are trying to build. Really typical for startups or companies. And just this is very typical of crypto, where you take this concept and you weirdly mutate it a little bit, and suddenly you kind of give out these advisory shares in ways that feels a little bribey. I think there's a lot of like legitimate work of people like, hey, I've got some stake in this company. This is me giving my time, and so I want to participate as an advisor. I'm going to do actual work here. And that's probably maybe an in-between of these two different models. And then there clearly is just some, hey, I'm trying to sort of curry influence with you based on your position. So I'm going to give you this free option here so that I've got you incentivized. And that's the part that does feel a little bit, you got to be careful with that.
And let me hedge here a little bit, right? Like, so it's not just Justin; it's also Don Crowder.
We got to defend Justin Drake here.
Yeah, I'm going to give him a break here for a second. But like the other side of the fact is that friend of the pod, friendly with him on Telegram a little bit, but like follow him on Twitter. But like the other thing is that like he has contributed a ton to both like the Eigenlayer research side, and he has been on podcasts with Bankless and stuff like that, talking about Eigenlayer security and making sure that this is safe for Ethereum. And so he has a vested interest to make sure that this works. Like part of his job at probably the EF, if assuming he's an employee or a contractor or something, is actually to make sure that like Ethereum works. Like it's part of his job, like it's part of their jobs. And like there's a world where like it is very valuable. It is valuable to like have them and have access to them. A lot of companies do this, right? Like maybe it's like they pay them something in salary or like or some sort of like retainer. Maybe they give them some shares as well. Like this isn't something that's like new or different in crypto. I think, and I'm just saying like, the problem here again is like, it's not just like in fact, it's also in perception. And the perception is like actually is reality. Perception is reality. And so you have to manage both. And not just like brush it off, because it is actually quite important to the credibility of like both the individual, but then again, like also the organization that you represent like full time.
Yeah, that's very true. So basically, I would treat this as a look. This is the big story of the day, and I think my like zooming out of all of this stuff, conflict of interest stuff is extremely important. My sort of take on this is that Eigenlayer ascended extremely quickly. Right? Yeah. I think even the internal team would have said the amount of TVL and the amount of LRTs and the ecosystem that we were able to bootstrap in a relatively short period of time, everything just happened faster than our wildest dreams, right? And so there were all of that's really great when that happens to you as an organization. But if you listen to, we've experienced, obviously, not quite at the scale of Eigenlayer, but like we've experienced periods of time of rapid growth at Blockworks. Or if you listen to guys like Olaf or Brian Armstrong talk about some of the crazy growth periods of Coinbase, it's good, but it produces all of these problems because all of these, you don't have the infrastructure or the processes needed sometimes to service the amount of revenue that's coming your way. And it creates its own type of stress and burnout and fatigue, and things fall through the cracks. And, I think that this is probably one of those things where
it could be a product of that. Yeah.
Yeah. So I think it's just something to be aware of for crypto companies in general, where, yeah. And there's some weird stuff too about, I mean, look, it's also very possible that this never filtered its way up to management. And these were frankly like rogue employees who were doing this stuff without informing management. Although it did seem like, based on the reporting, that this was a known list that actually got circulated to one LRT who didn't want to make that airdrop and felt pressured to do it. So if that's true, that's actually a little bit more damning. But I guess we'll have to wait and see how all the facts shake out on this particular.
Yeah, that I have no knowledge on that whatsoever. I think like there's these like. So like, are there other lists out there, right? Like, what are those lists? Like, how are those lists created? Who's on them? How is it distributed? I think like one of the questions that I've been having like in the back of my head is like, I keep seeing like, not to beat up on the EF right now, but I guess I'm going to, like, is the Protocol Guild. Like, I don't know a ton about the Protocol Guild. Like, and I've asked a couple of people and they don't really have any real understanding of it. But like, generally speaking, there's a lot of money that flows into it. And the question is just like, okay, cool. Like, there's no conflict of interest policy, right? So like, how does this capital get divvied up? Like, how buttoned up is it again, right? And like, and how does it work? It'd be cool to know more about it, and maybe some sort of like quarterly or annual like sort of like report on like what you did with it and like how it went. Like, it is a foundation, and like the way I view the Ethereum Foundation, out like, which is like, you know, to its credit, is like a public good, not like a privately run company. It's trying to be like the global settlement layer for the world, right? And for finance in the world, ideally. And so like, what are the disclosures that are necessary to like have public trust? And I think these are things that are like growing pains that probably are long overdue to be addressed. And like, I guess this is going to be ideally, this is a catalyst for change, right? These are learned behaviors, and which is good because it means that like they can be unlearned. And it's harder to unlearn a bad habit than it is to like learn a good one. But like, I think that like we're here for it. And like, I'm happy to, if anybody wants to talk about this, like privately or publicly, like I'll do the talk again, but like, I also happy to help people think through it, because we've had to deal with it ourselves here. Right. Like, I think everybody has to deal with it like at some point. And it seems like now is like probably a pretty good opportunity for a lot of people to look in the mirror, and teams look in the mirror, and founders look in the mirror, and make sure that like this kind of stuff is like buttoned up, and like, you know, measure twice, cut once.
Right. And you know, lest it feel like we're picking on the Ethereum Foundation or Eigenlayer here. Obviously, that's just, these are the news stories that have broken. But I'm sure that this is I'm sure that this is an issue for many different corners of crypto. And I think it's just I agree with your message there. Like, let's use this as a wake up call. I'm sure this has been a wake up call for Eigenlayer, but you know, for other organizations where this might be a challenge, and you know, just like many organizations in crypto are going to need to deal with this. So just, you know, take the time to do it now rather than later. Again, it's a way to protect your organization and to make clear rules of the road for your employees, and just make sure that you avoid this type of thing, because you know, no one likes seeing these types of headlines. Everyone's invested in this industry, and you know, I'm assuming that if you're operating it, have like a deep fundamental belief that it produces good. And so, you know, these are the type of things that just create optical setbacks, especially during a period of time where crypto's moving into the world stage. And yeah, I would echo your belief. Like, I think Ethereum is going to be one of the most important platforms maybe to ever be created. I think that, you know, Solana's in the running for that as well. Bitcoin has probably already moved into that phase. And so, yeah, you know, the stakes are high. Like, this is what we play for. You know, it's a great problem to have, that there's a lot more eyeballs now, and just in terms of how everything works. And so, yeah, I think it's a good thing for everyone to just be super aware of. But yeah, deep breath, Jim. What do you have, Jim? Do you have any fun plans this weekend? Are you
Yo, actually, I think the last time that we talked, I was talking about fish, right?
Yeah.
So guess what? They're doing a festival this weekend in Delaware. It's called Monday Green, which essentially means like messing up lyrics. Is like a word for messing up lyrics, and it's like one of these like, it's a 4-day festival. It starts today. I'm obviously not there. I'm gonna go for Friday and Saturday with my best friend Sam. We're gonna drive down. We're gonna spend 2 nights like on the campgrounds camping like we're 20-year-olds again, and then I'm coming back on Sunday. My wife was my partner was like very generous and like kind of like gave me the approval. And you might be like, why are you asking for approval? Like, you're a sovereign person. But we're also expecting our first
How
kid.
sovereign are you if you're married, really, at the end of the day? You're
it's sort of like
sovereignty interoperability trade-off that people like to talk about.
It's intersubjective sovereignty. Yeah. And so, but like, you know, we're expecting our first kid in October. So this is probably like sort of like one of the last things that like I get to do with like my best friend, like without any sort of like attachments to the hip, literally. Yeah. And so we're going down there. They're doing 4 nights. It's going to be pretty awesome. They've been playing all summer. and the jams have been choice. So like we're really excited about like going down there and checking them out. I haven't seen them all year. What about you? You got anything going on?
I'm going to visit, my girlfriend and I are going to visit some friends of hers in Michigan, actually. So I've been out. I think I've probably spent one weekend in New York since June. I've been doing I was in Ireland. I was in Martha's Vineyard. I've been bopping around all over
Racking up those miles. Like, I mean, that's like
those miles.
Not just crypto conferences. You're also doing personal stuff. That's good to see. Like you're mixing it up for that.
Try to mix it. Have some non-crypto people in my life. And by the way, I would recommend that because it's very easy. I would say that crypto Twitter right now is at an all-time low in terms of both vibes and signal to noise ratio. So it's a good reminder to build a life outside of there and go touch grass and do all that. It's not just a meme and thing people say. It's go do a fish concert. So I think that's
going to do 2 nights. If anyone's there, message me. I'll be on. Hopefully, I'm not on Twitter too much like over the weekend at Velvet Milkman. And
if you tweet, I'm gonna be in your replies, just saying, "Get off this.
Get the heck off of here." Like I don't think it's gonna happen. So I got the day off, my first day off in a little while tomorrow. So like I should be off like by noon.
Yeah.
Hopefully.
All right. Well, give Jim a follow. He's Velvet Milkman on Twitter, criminally underfollowed. And Jim, I appreciate you hopping on here. And I'll have to do it again sometime soon, man.
Hope to, and see you in the next couple of weeks. Probably it would be good to hang out.
I'll see you around, brother.
All right, see you.
Hey everyone, hope you all enjoyed today's episode. Want to give a final shout out to Namada, again, a team that is near and dear to my heart. They are building the Shielded Asset Hub, which is protecting the future multi-chain. Talked a little bit about how that works in the mid-roll, but for now, what I would highly recommend that you do is go check them out. They're in their mainnet launch phase. You can follow along with everything at namada.net. You can start rewarding yourself by shielding your actions and strengthening data privacy for all across the multi-chain. So thanks again, Namada, for all the great work that you're doing.